I'm in the green all time with Netflix. It's real. It really is real. This is the all time. I'm in the green by $667. Now, normally this isn't something that I would show off or really brag about by being in the green in a company by 3.5%. Nothing about that in and of itself is achievement worthy or even noteworthy. But the reason that I highlight this with Netflix, the fact that all time I'm in the green on this company, is because this company, this stock went through a 74% drawdown. 74% of its value wiped away. And I held this stock the entire time. And that does have some meaning to me. When a stock drops 75% that you own, that has an impact. That has an emotional toll. That makes it very difficult to know what to do in that situation. With Netflix, I was able to hold on to this company, hang on to this stock, and actually turn it from a $20,000 loss into a gain. And I want to go through this crazy story of owning Netflix through this time period and give you some insight into what I was thinking at different time periods. Of course, we also have an update on the Story Fund, its performance against SPY. It is racing back up to catch the S&P 500. We have more news on Netflix. Their password crackdown seems to be working. There's people that were questioning Netflix that are now admitting defeat, saying that Netflix won. We have Netflix having a chilling effect on foreign content. Different countries are now concerned that Netflix is basically taking over the media world. And then we also have Netflix going in to streamed sports. They're going into live stream sports, and these are a little bit different. This event seems like it's a Netflix celebrity golf event that they're actually creating. I'm going to give you my thoughts on this as well. And then, of course, we have the FOMC meeting. That's where the Fed meets together and determines the interest rate, whether they keep it the same, raise it, or lower it. And they're expected to keep it the same. So I'll be going over that as well. Now let's go ahead and jump right in, and we'll start off with a portfolio update. We have a lot of new people join this channel every single month, a couple thousand every month. And welcome if you're new, but I want to also mention that this is not my only YouTube channel. I have one that goes under my name, Joseph Carlson. And in that one, I follow a different portfolio called the Passive Income Account. Passive Income Account has a little bit different of a strategy, and this is really my main portfolio. It's where I put the majority of my money, the majority of my new money, and this one has been going great. It's up 85,000. It continues to make market-beating gains this year and last year. But today we're focused on the Story Fund. The Story Fund is a portfolio that I started to talk about a different type of company, which is more in line with highly volatile tech companies. So I created this portfolio because I wanted to do research and analysis on these companies, and I always think it's more interesting to do analysis when you have your own money at stake. Talk is cheap. Putting your own money at stake and showing the results, that's where I think it's a little bit more interesting. Now, in this portfolio, I have it weighted towards a couple companies. It's heavily weighted towards Amazon and Netflix. These are two huge companies that I put a massive weighting towards. Now we have a lot in Google, but this wasn't the case for the majority of this portfolio. This is a very recent thing. I had most of the money, 40% about, in Amazon, and this one's just done terrible along with Netflix. And then we have Netflix being about 25%. Last year, both of these companies were struggling dramatically, and they've all had a resurgence. This whole portfolio has had a resurgence. Every single company, every single big tech company has had one incredible year. Now, I don't have all the percentages on hand, but companies like Apple are up 40%. Amazon's up 45%. Tesla's up over 100%. Even though I don't have that one in my portfolio, that one's doing really well. Netflix is up 40 or 50% this year. Google's up like 30 to 40% this year. They're all doing great. Even Microsoft is doing great this year. So all these tech companies really got hammered in 2022, and now they're having a big resurgence. Since I intentionally overweighted my portfolio into big tech, not as many smaller companies, but mostly into big tech, my portfolio has likewise recovered far faster than both the S&P 500 and the QQQ. If we look at the recovery here over the past year, this illustrates the relative recovery of my portfolio against the S&P 500, which I'm benchmarking it against. So we have the Story Fund in blue, we have the S&P 500 in red. Right now, the Story Fund has really caught up. It's in the green a little bit, a couple percentage, and now it's only about 4 or 5% away from the S&P 500. That is not a big difference. That can flip very quickly. In a day, that could flip. And this was not the case a while back. In fact, just a year ago, this looked pretty bleak. Right around this time period, 7/21/2022, that was a tough time for the story fund. It was really getting crushed, and the relative difference between it and the S&P 500 was over 25%. So a huge difference in performance. And this continued on. It was really a pretty big difference for a long period of time. For about a full year there, I showed continual updates. I showed transparency, even though I was trailing the S&P 500 by a pretty huge extent. And here we have that gap being closed. And that was my goal, to close the gap. And that's what we're doing right now. So right now we have the S&P 500 still a little bit ahead of the story fund, but that gap is closing quickly. And every single day we're inching more and more towards it, which I think that eventually we're going to be able to beat it. My goal is by the end of 2025 to outperform the S&P 500, to have it be so that at the same time period that I put my cash in, it would have performed better in my portfolio than had I put that cash in the S&P 500. So that's the goal. It's a little friendly competition. In the end, I hope I make money and I hope it goes well, but we'll have to see how it turns out. I can't see the future, so the only way to find out is to follow along for free, and I'll continue to show these updates transparently. Now that we've taken a look at the entire portfolio's performance and the huge recovery of the story fund, at one point down $40,000, now into the green, I want to focus specifically on Netflix. The first thing that I think is important to point out here, because there's still a lot of confusion about this, a lot of people that are still debating this. Which streaming company is going to win the streaming wars? You're still seeing articles like that. It's been decided. This has been decided for a long period of time. Netflix has won. They have already won the streaming wars. They've defeated their opponents so soundly in streaming, even with the monumental efforts of Disney and Warner Media and Apple TV and Amazon. All of those companies competing in streaming have not come close to Netflix. This company is internationally diversified, highly profitable, even adjusted for stock-based comp, and has way more subscribers at a way higher monthly price than any other streaming company. They are so far ahead of other streaming companies, it's not even close. A lot of streaming companies are on Lifeline. A lot of them, like Paramount Plus, lose hundreds of millions of dollars every quarter and only have a couple of key shows. In fact, streaming companies like HBO, streaming companies like Paramount, most of them have 2 or 3 shows that make up 90% of their viewing. That's highly concentrated into a couple shows on their service. Netflix has thousands of shows. They recycle their shows every single day. There's new shows fresh to their content slate every single week. Blockbuster movies multiple times a year. Their content slate is heavily diversified. It's satisfying a huge range of audiences all across the globe. Their content, their subscriber count, and their profitability show a very different picture for Netflix than every other streaming competitor. So the race is over. Netflix has won, and now they're in the mode of being a highly profitable, free cash flow generative company that I think is going to generate huge profits for investors. So how did we get to this point? Let me go into a timeline here. We'll bring up Netflix here on Qualtrim. And this software, by the way, that shows you all the fundamentals of a company, it's available as part of the Patreon. $10 a month, cancel anytime. I think you'll love it. Well, let me just bring up a simple price graph here. We have the year to date, but I want to go back a little bit further. This is my story of me being involved in Netflix's stock. I want to go over the timeline here. So again, we're looking at the 5-year time horizon. This goes back to 2018. I started buying Netflix right when I started the Story Fund portfolio. So it was about 2020 into 2021. This is really when I was buying the company. And on this chart, looking back in hindsight, this looks like I was buying it at an expensive point, right? It's not up to where it was when I was initially buying the company. That's true. But keep in mind, during this time period of 2020 to 2021, everything was expensive. If you bought anything in the stock market, it was likely pretty expensive. In fact, the entire S&P 500 was much higher then than it is today. So it's easy to look back and say, oh, you're buying high. Yeah, everything was buying high during that time period. If investors had a crystal ball, no investor would have bought then. They would have waited until 2022 and 2023. So this was a time period that I initially started buying the company, right around here. I wasn't buying the company when it spiked up to its peak here. I was mostly buying it right around this range of around $500 per share. And at this point in time, Netflix had been a long-term compounder, a company that have given incredible gains. In fact, looking at the all-time chart, it is insane. Netflix had just continually gone up, especially over the past 10 years, 1,260% gains from where it is today. So at this point, it was like 1,500% gains. It's been a marvelous stock to own for those investors. But the reason that I was buying into the company is because I thought strongly that Netflix was getting to a point where it was finally getting to free cash flow positive generation. The company was finally going to generate a lot of free cash flow and it would have a lot of operating leverage. So I'm buying right there. Then the stock price ticks up pretty high. Investors get very enthusiastic. And then something happens. The stock drops like 30%. Huge drop. And the reason why it dropped this 30% is it was the first time that Netflix lost subscribers year over year. This was the news that Netflix, they went out of Russia, so they lost some subscribers there, and then they actually had a little bit of a pullback. It was an interesting thing. The management's tone really changed from being super confident to now talking about a lot of different issues. But they were still at this point pretty confident. Management had an optimistic view. They said that they had Russia affect them a lot. There's some shakiness with the COVID pull forward type of thing, and they lost 400,000 subscribers. So investors become very concerned. They're now losing subscribers, not gaining subscribers. And the analysis up to this point was that Netflix was going to continue gaining subscribers. So I thought that this was not really concerning. I looked at it as Netflix having 220 million subscribers and them only losing 400,000, which is less than 500,000. So 220 million subscribers, they lose 500,000 and they're down 30%. That didn't make sense to me. But right then, it was the first sign of concern. Now, at this point in time, we had another investor step in. We had Bill Ackman decided to step in and buy the stock. And he bought pretty heavily. He bought it as a large concentrated position, as he does with all of his holdings. And then Bill came out with a huge research analysis saying that he had actually been following Netflix for a long period of time, that the company is expertly managed, that the company has global scale, and he highlighted many of the exact same points that I've been saying for a long period of time. And this seemed like expert timing from Bill Ackman. Netflix was a high quality stock that had some weakness, and that weakness caused the stock to sell off 30%, offering an attractive entry point for a big name investor like himself to make this a concentrated position. At this time, I bought more as well. In fact, I bought quite a bit more. I think I put in like another 5,000 to 7,000 at that point, which was bumping up my position even further. So I bought here a little high. This is 2020, 2021. And then the stock fell 30% because of subscriber weakness. Bill Ackman enters the stock. He buys more of it. That's a little bit of a confidence boost. I'm going, wow, Bill Ackman's in the stock. I respect Bill as an investor. I respect the detailed level of analysis and research he does. So I'm feeling a little bit better knowing that I have someone else that's bullish on this stock, that's a respectable investor, that's putting his reputation on the line. So I'm buying more as well, thinking Netflix is eventually going to recover. Even though they lost 400,000 subscribers, the overall thesis of the company I still think is intact. Then the next quarter, Netflix loses more subscribers and projects 2 million subscriber losses. They say that they're going to lose 2 million the next quarter after that. This is when the stock really crashed, moving down another 30%. Now from the high to the low, this is now around a 74.5% drop. So a 75% drop in stock price from the high to the low. This bounce right here, or this drop right here rather, was extremely distressing to investors. We had just gone through a 30% drop, and here we have another 25 to 30% drop right afterwards. Extremely, extremely distressing to investors. And the company all of a sudden changed their tone. They went from being a company that was super confident in their growth and they have a little air of arrogance to them. You know, they control the world and streaming and everything. And now they're saying, Yes, competition is impacting us. Yes, we did have some pull forward through COVID. Yes, we're still trying to figure this out. They're also implementing a bunch of different plans. Now saying that they're going to start charging people that were normally sharing passwords, which we don't know how that was going to turn out. That was a big question mark. And there's a lot of people saying that that's going to turn out poorly. They also said during this time period that they're going to implement an ad tier. So now Netflix is changing from this nicely branded premium subscriber content to now ad supported. So the management's changing lots of direction. The company seems like it's faltering. It's no longer growing, but it's shrinking, and investors are bailing, re-rating the company way down from a 42 PE ratio down to an 18. This was an extremely distressing time. I did a portfolio update at this time, and I want to show what I showed at the time. So here I am. This is back, let's see, May 4th of 2022. So this was in the midst of it. I didn't turtle in and not show you what happened. I show right on the screen my Netflix holding down $17,200. This was way over half. I was down around 60% in this company. So that takes, I think, it takes something to show when you're down this much in a company. A lot of content creators are not willing to do that. But that's what you get with this channel. I'm not going to just show when things go well for me. I'll show when they go bad as well. So here we are, another 30% drop. The management seems like they're scrambling. They're trying to change the narrative and change the tone around it. But we know that Netflix is struggling. Now, this is also difficult because right here, right there at the very beginning of this drop, Bill sold. So now we have Bill Ackman selling the stock 30% lower than he just recently bought it, going from bullish to now just unknown, selling out at a huge loss. In fact, Bill Ackman's loss was $300 million in just 3 months. So he lost $100 million per month in this company. And the reason that he said he sold the stock was a respectable reason in terms of his thoughts and analysis. He basically just said, look, I came in with one thesis. I thought that Netflix would be able to recover, but now it's an unknown. It's too unpredictable to have as a concentrated position. I disagreed with Bill Ackman. I do not think that Netflix is all that unpredictable. After all, the company only lost just over 1 million subscribers, and they have 220 plus million subscribers. So it was still less than 0.5% of their total subscriber base. Not really something that I thought was too dramatic. But regardless, this was another thing that was a little bit of a bummer to investors in Netflix. You once had this big, brilliant investor in the stock with you, and he just ran for the hills. He just exited. He put doubt into the stock. So the stock continues to fall another 20% after Bill Ackman sold. If you can actually believe it, this mark right here is 20% above that one. The stock was down so much that just the slightest change makes it another 20% drop. So at this time period, I'm thinking, well, Bill Ackman sold out of the stock. Everybody seems to be selling out of the stock. People are dunking on me on Reddit and on Seeking Alpha and on YouTube comments, and even other channels are mocking me for owning the company and overpaying for it. And I thought, I didn't buy into this stock because Bill Ackman bought the stock. I was buying into it long before he had anything to do with this company. And I've been studying Netflix for a long period of time. I have real belief that they are going to be the winner in streaming, that they will have good economics, that even with this hiccup, which I think is understandable given that they gained like 20 million subscribers in a month during COVID, I think that they're going to be able to recover. And at the time, at this time period, it was tough. This was what I would admit the most difficult time period. It was tough to go on and share my performance, share that I took a massive hit with this company, share that I had weakness in my analysis, not forecasting that they're going to have such a massive subscriber loss. That's something that caught me off guard. And so I had to go on and admit that I have a problem here with Netflix. But I did not believe the company was in as significant trouble as the market was pricing in. Netflix had traded down below a PE ratio of the S&P 500, as if the company's market position and strengths and future profitability was worse than the overall market average. And I thought overall the company will recover. So during this time period, I decided to start buying the stock again. I had bought it right here, I bought more of it right here, and I bought more of it at the lows. This was difficult to do, much easier said than done, but I did continue to buy the company. Here's my recent trading activity with Netflix, and I'm not filtering out sells here. I have not done any sells. That's why they're all buys. I continued to buy this company through thick and thin, and especially after it dropped in price, I was trying to buy as much of it as I could. That's why you're seeing these purchases here and here and here. You know, these are big purchases. And a lot of people say, oh, that's easy when you can throw more money at it. But a lot of this was my savings. I was not expecting to put this much money in Netflix, but I believe so strongly that if I could get my cost average down, if I could buy more of the company and get the cost down, that when the recovery does happen, I could get in the green a lot faster. I wouldn't have to wait until the company gets back up to $500 per share. If I could get my cost basis down, I wouldn't have to wait that long. So I lowered my cost basis from 500 to around 420. So the actual cost basis came down dramatically as I continued to buy the company. Now, during this time period, it was really confusing. And again, looking back, it seems so simple, but you have Bill Ackman selling out during this time period. So even good investors have lost faith and they've given up on the company. At the time, I came out with an analysis that was a Patreon exclusive analysis. So I posted this on my Discord for Patreon members, and it was called Netflix Updated Thoughts, December 1st, 2022. And I go over the state of Netflix. This was what was happening with the company. Here's a few things that have happened over the past year. Netflix reported subscriber loss 2 quarters in a row. Netflix's subscriber loss resulted in destroying investor confidence, causing the stock to drop over 70%. Netflix has changed their mind on having no ads and has introduced a new $7 per month ad tier. Netflix has decided they will monetize password sharing accounts. Netflix admitted that they face real competition in streaming. Netflix made a pivot into gaming. Netflix has done layoffs and budget cuts. That was a summary of all the facts. Get rid of all the noise. This is exactly what happened with the company. Now I go on saying that the damage to Netflix story over the past year is real. Investor confidence has been shaken. Even Bill Ackman purchased into Netflix to buy the dip and is quickly sold out only 3 months later when Netflix had another disappointing quarter. He's now stated that the stock is too unpredictable for his concentrated portfolio. This is where I continue to strongly disagree with both the market and Bill Ackman. I don't think that things are so bad for Netflix, and I don't think that the company is unpredictable. In fact, I think Netflix is one of the most predictable companies in the market. I believe Netflix remains one of the most clear and predictable long-term winners in the equity markets. While many, if not most investors, continue to focus on the facts above, let's take a look at a few facts that they fail to consider. Here's where Netflix stood right now. This was again December 21st, 2022. Netflix subscriber count is 223.09 million, the highest it's ever been. Netflix forecast a subscriber gain of 4.5 million in Q4 of 2022. Netflix is growing subscribers after just recently increasing prices. Netflix has the highest average revenue per user by far in streaming. Netflix is a free cash flow positive even while considering stock-based compensation. Netflix long-term debt has been reduced for 7 quarters in a row. Netflix continues to dominate streaming engagement, routinely topping the list of the most watched and loved shows on the internet. In the past week, for example, Netflix had 9 out of the 10 most watched shows on TV. HBO had 1 out of 10. Even without big brands like Star Wars, Marvel, Netflix continues to produce breakout hits like Dahmer, Wednesday, which just broke the record of the most streamed English-speaking show in a 1-week period. Netflix is producing better blockbuster content over time. The Glass Onion, Knives Out sequel had a pre-release in the theaters to produce buzz, and it was rated an 8 out of 10 on IMDb, 93% on Rotten Tomatoes by both audiences and critics. This will be released in December 23rd to everyone on Netflix. When I consider all the facts surrounding Netflix, I don't see a distressed and struggling company. I see a company that is dominant and thriving. Netflix is the only streaming company at scale and generating positive free cash flow with their streaming business. Netflix is still profitable and growing, despite all their competitors spending tens of billions of dollars on streaming to chase Netflix. Now, Netflix stock is up around 50% from this research released and up around 150% just over the past year. The stock has been on a steady climb. Now, look what has happened since this time period. Netflix stock has obviously recovered to a great deal. The buys that I did here really helped out my cost basis. They lowered it down. So now I'm in the green at a much lower price than what I was buying in originally. At the same time, now Netflix boasts a market cap of $193 billion. We can look at Disney's, for example, the next biggest entertainment company in the world, at $171 billion. Netflix is a bigger media streaming entertainment company than Disney, a bigger one by $20-30 billion in market cap. And if you actually took out the park resorts as part of Disney, which would cut their market cap in half, Netflix is not even close to Disney. It's massively bigger if you're just segmenting the media properties. So that brings us to where we are now. Netflix has won. They're the biggest media company in the world, and they're the most profitable, and they're growing profits at the highest speed. The stock has recovered from being an embarrassing $20,000 loss to now a $420 gain. In and of itself, that's nothing to brag about. The $420 is not great. I have companies that have done much better. I have companies like Apple and Microsoft and Texas Roadhouse that have been much better investments, but I think there's something to be learned here. I think there's some analysis we can do on this. First of all, I think a big thing in investing is the talk of, I'm not concerned of volatility. I'm not worried about volatility. Let me tell you firsthand, volatility is not that fun. And if you can avoid it, then avoid it. Because being down 75% on a stock, being down $20,000, it plays games with your mind. It makes you become overall bearish on the company. All you're getting is negative news. The story's dead. Netflix has competition. They have no room to grow. HBO and Disney are now charging in and taking their market. And you overpaid. You're stupid for overpaying. You should just sell the loss, get rid of it, get rid of that ugly red out of your portfolio. Just sell it off and move on. That is all the types of pressures you're getting when you're down that much in a company. And that is volatility. So it's easy to say, I don't mind a little volatility. I can handle it. But can you really? Do you really want to go through that? I've gone through companies that aren't that volatile, like Costco. And I've gone through companies that are very volatile, like Netflix. And let me tell you, I prefer the non-volatile ones. I like companies that just trudge along upwards steadily over time. I don't like going through companies that have 60% drops. If I can, I'll try to avoid that. That's the first thing. So don't try to understate the impact of volatility. It can trick you into making very poor decisions. In the case of Netflix, it worked out in my ultimate benefit because I was able to ultimately lower my cost basis in the company, which is mathematically better. But I had to go through a great deal of just concerns and problems and a lot of derision and things in the process. This wasn't a fun process to go through. So if you can avoid it, I think the better route to go is to avoid volatility, not try to seek it out intentionally. The next thing I think you can learn is to stick with your guns. If you've done the research on a company and you really feel bright about its future, don't get talked out of it because of someone else, even if that someone else is someone that you respect. People that you respect can make bad decisions from time to time. In this case, someone that I have said I respect as an investor is Bill Ackman. He bought into the company here. Bill bought right there, and then he sold 3 months later at a 30% loss. He's a respectable investor. He has good returns overall. I respected him, but I did not follow his trades. I didn't buy in and sell out, which now is at a substantial low. Netflix is up 200% from where he sold. So he sold at a low point, and Netflix, from where he sold, has beat every single one of his investments that he's invested in. It was the worst decision he's made over the past 2 years. Now, he'll say that it was a fine decision because it was unpredictable. I disagree. I think that he bought into the company. It got a little scary when it traded down, and he sold out very quickly. So even though I respect people like Bill Ackman, if you follow their trades, if you follow him into the stock, you're going to be more inclined to sell out if they sell out or if they make mistakes because you don't have conviction by yourself. I had done a lot of research on Netflix. I felt very strongly about the company. That allowed me to stick with my guns with this company. So that's the second thing I'd point out. The third thing is to just not listen to haters and the noise and people that criticize you. If you bought into a company and people try to make you feel dumb for it because it went down, they are just trying to point out specific periods in time. A lot of them are doing that just because they're completely negative. If I had listened to all the haters during this time period, I would have sold at lows, but it didn't affect me. Just ignoring them is something that's part of YouTube and doing this. So sticking to my guns, not paying attention to haters, and not having my conviction based on Bill Ackman, I think was a big part of it. Long term, I continued to believe the entire time that Netflix will generate a lot of free cash flow. So that's some just reflection on this. I think it's been a learning experience. It's been an interesting company to hold. That brings us to where we are now. The company has a much bigger market cap. The valuation has gone up from what was dirt cheap to now a more expensive company once again. It went from an 18 forward PE to now a 29. So a lot of people are saying right now Netflix is expensive. The PE ratio is a little odd with Netflix, the way they amortize things. What I look at is the free cash flow yield adjusted for stock-based comp. That is my ultimate metric of what I think is the true profitability of a company. When I look at the yield of that, Netflix right now is trading at a trailing 12-month yield of 1.21%. And that is a little bit more expensive, but Netflix has guided for $3.5 billion in free cash flow this year. They raised their guidance from $3 billion to 3.5. 3.5 out of 193 is a free cash flow yield of around 1.8%. So their free cash flow yield right now on 2023's estimated cash flows is around 1.8%, just under 2%, even adjusting for stock-based comp. I don't think that's so bad. It's a little bit on the higher end. It could trade down a bit, but I don't think it's so bad for a company that's showing the strength that it has, like Netflix has shown. And by the strength that it has, I mean a company that is increasing prices, that is gaining subscribers, and now they're making grounds on password crackdown. We can look at the news here. This is another thing that I vocally and publicly said that I disagree with all the people saying this is not going to work. Many people saying that Netflix's password crackdown is going to destroy the company. We have analytics here showing that the password crackdown, as far as they can see so far, which isn't confirmed, so Netflix can't take a victory lap yet, but as far as they can tell by third-party analysis, it seems to be working. While some of the users have canceled their accounts after the crackdown on password sharing, I'm sure many of you have, there's some people very upset about it. According to the data from analytic firm Antenna, Netflix saw a sharp rise in account signups after the rule came into force in the US. Antenna says that Netflix had 4 single biggest days of US signups in the 4.5 years since it tracked the data. So the 4 single biggest days of signups were after the password crackdown. There were almost 100,000 signups each day during each of the 4 days. The company saw an average of 73,000 new memberships, according to Antenna. So that's net new memberships. They say while account cancellations also rose in that period, Antenna said signups far outpaced those figures. So churn was probably elevated, which means people signed at an elevated, they canceled at an elevated rate, but also signups were elevated even beyond that. So the net gain is in Netflix's favor. And I've gone over the math of this. It works out in Netflix's favor ultimately. So in terms of the password crackdown, this has been a success for Netflix so far from what we know. Other things that seem to be happening with Netflix. Other countries are seeing how dominant Netflix is. South Korea, for example, they have such a huge amount of Netflix produced content taking over their airways that they're actually concerned about Netflix becoming too powerful. As some people in South Korea's entertainment industry see it, is the overwhelming importance of a single channel to distribute their content. Quote, as a studio and as a producer, I'm a little concerned that Netflix has been the only channel global audiences can watch Korean series on. Netflix is it. It's the one player producing global entertainment, and that's making it a little bit concerning for Korea. They're also mentioning that many TV producers and regulators are long worried that US-based companies such as Netflix and Amazon would decimate local TV networks. So they're basically saying in South Korea that they're concerned Netflix, as well as other streaming companies, but mostly Netflix at this point, are simply becoming too powerful. And I agree with that. I think that Netflix is becoming powerful enough to look at in a regulatory way. In South Korea, they're having massive gains there in subscribers. Now, there's also news, and this is something a little bit different, but I think it's a great growth path for Netflix, that they're getting more into live events. They're not just broadcasting NBA finals or live events that we know of, but Netflix is doing more experimentation with live events, like the Chris Rock comedy special. That was a live event that was hugely popular, and now they're trying to do that with sports, creating their own golf tournaments. Netflix to enter live stream sports with celebrity golf event. This one looks pretty interesting. Golf is becoming more popular over the past year. I think that's largely driven by Netflix documentaries like Full Swing. But they say that the company is in the early discussions about a golf tournament. Some of the people said set in Las Vegas. Long Vici, we love Las Vegas here. The event would feature celebrities from Drive to Survive, a docuseries about a Formula One auto racing, and Full Swing, which followed professional golfers during the 2022 season. So here's Netflix building out their own ecosystem, their own franchises. People say that Disney has all the franchises and all the IP. I would argue they don't. Netflix has built out their own. And now they have docuseries like Formula One and Full Swing, which they're now intermingling with live events, a live golf event. So you get to see these stars now play golf together, which I assume will be a very popular event. What Netflix is doing here, I think, is genius. They're finding ways to monetize sports, to have people view their content because they're interested in sports without the expense of licensing sports. The reason that Netflix doesn't license the NFL or the NBA is it's just too expensive. They don't want to pay for it. So they're able to monetize sports audiences without the expense associated with sports. I think it's a very clever strategy that they're doing. Right now, I remain bullish on Netflix. The price has gone up. The margin of safety has gone down once again. The stock could trade further down into the red. I could see it trading down after a bad report, or if investors lose confidence, or if the Fed does something again. I could see the company going down. But again, I'm looking at this very long term. I think Netflix will grow past $3.5 billion in free cash flow to $5 billion and to $10 billion. And I think they are going to show continued operating leverage far above most analysts' expectations. So as of right now, even though the stock could trade back down and we could be in the red again, right now I'm holding on to it because I just look at it too long term. I think the company is going to continue to do great. That's all for this episode. I hope you enjoyed. If you want more content, make sure to join the Patreon, and I'll see you in the next one.